Thank you very much, Mr. President, ladies and gentlemen. Buongiorno. It is great to be in Rome when we talk about Solvency II, because Solvency II was a revolution in insurance regulation. And where else can we discuss about that than in Rome, the place where the European Union was founded? And we are going to celebrate it very soon, Gabriel, so we should always keep that in mind. And Rome, ladies and gentlemen, was not built in a day. That is a message that I repeated many times when I was talking about Solvency II at many conferences. And we should keep that in mind. The system is not perfect. But what we are trying to do with you this morning is to look at it, to see how it started, what lessons we can learn from that, what improvements are possible, and what we are going to look at is at the real facts, not the alternative facts. We want to know the truth and not but the truth. And we have 6 people around this table to help me in doing that, representing industry and the supervisory community. Our focus will be on small and medium-sized enterprises, and we'll cover 4 different topics. The first one is a preliminary assessment of the entry into force, the first application of Solvency II, remembering, of course, ladies and gentlemen, that it only started 1 year ago. So it is really only a preliminary assessment. The second topic we are going to discuss is what is the impact, particularly of Solvency II for the small and medium-sized enterprises. And we already heard about that this morning, but let's see on the face, in the real world, what people think about that. Then the third issue, of course, is proportionality. Very important principle. We'll talk about that. Also, what are the practical consequences of that? And last but not least, as the 2 speakers before me have done, we're going to look into the future. Let's see, where are we going? What are the challenges? What are the opportunities? But let's start with the first topic, and preliminary assessment. Sylvia, in Ireland, what can you tell us? What does the Irish tiger think about Solvency II? How did it work? Sylvia.
Okay. Well, good morning, and first off, I have to say I'm a novice. It's my first time in Rome, which I can't believe at this stage in my life, but it is absolutely wonderful. President Rossi and Alberto, many thanks for inviting me. The first thing I'd like to say is that Solvency II has had a very positive impact. When we look, we're looking at a complete change in language. We're now talking about a language of risk. Previously, we were looking at rules, and we were looking at conformity, where we were looking at compliance. And if we look at small companies, what do small companies think about? Small companies usually, they're startups, they're niches, so they're very much creative people who tend to focus on a product, they focus on the beginnings. And for me, when I look at Ireland and I look at Ireland as a nation, small means agile. And when we look at agility, Solvency II is much more prone to agility than Solvency I was. I think when we look at the 3 pillars, the one of most importance, even though it's not the one that requires the most work, but the one of most importance for small and medium-sized companies is the governance one. Under Solvency I, the board of small and medium-sized entities, they focused on, okay, am I complying with the rule book that exists? And in reality, what they did was they were presented with the position at the Solvency I position, they reviewed it and they approved it. Now they've got to question, they've got to look, they've got to make decisions. This is something that is a sea change for the directors on boards of small and medium-sized entities. And it's a change in mindset and a change in culture that's required within the boards. What we've seen, and we talk about diversity, we've got to look at diversity of thinking with the introduction of Solvency II. and in boards, on the boards of insurance companies, yes, it's critically important that there are board members that understand the regulatory environment, but what's more important is what is the business model of the company, what are the stresses that are there, what scenarios have been reviewed, and what challenges are being put there. And in some ways, when we look at it, we look and we say, a small company, it's like a child. You know, I look and I say, okay, small companies, we're like a child, the medium size is like a teenager, and the adult is the large company. What do children do? You know, anyone who's a parent will know that you've got different types of children. You've got compliant children, and you've got very demanding children, and children who challenge all the time and question all the time. For within the Solvency II environment and within the new environment, that child who pushes the boundaries all the time, questions what's going to happen, can I get away with this? From a regulator's perspective, what is our job? Our job is to look at, use supervisory judgment in terms of what is the company doing, look at the business models and say, okay, what does that business model look like? What is the company trying to achieve? Do the board of directors of the small company understand what are the risks that are being faced by this company, or are they blindly following a path? So from Solvency II, there's a huge role for the board members, there's a huge role for the executive to present to the boards exactly what the plans are for the companies. And I think this is where data comes in. Suddenly we've got an explosion of data in relation to the QRTs. From industry's perspective, struggling to actually get the data in place for all the QRTs that are required. From the regulator's perspective, we've got to cleanse the data that comes in, and we've spent a significant amount of time, I think this year, probably more time than we expected, ensuring that that data is clean, because garbage in, garbage out. What we will have as a result of it is going to be a very transparent, cohesive set of data and set of measures that throughout Europe we can finally have a common European framework.
Well, that sounds fantastic. The world looks bright. Axel, I would like to hear from you, from the German insurance industry. Are you equally excited about Solvency II and the first time implementation? It's just a question.
Well, Karel, after about, I think, 6 conferences like this in Germany, where you always said Solvency II is good for you, people are still on the way of believing that. I think we have done over the past few years our homeworks in a quite efficient way, and I think looking at the low interest rate environment we're currently facing, I don't want to imagine how the German market, especially our life insurance industry, would look like without the QISs, without the testing, without an early adoption to the market valuation system. So I think there are clearly benefits which we see from the process which has started some 16 years ago already and now is ending up in the final application of Solvency II. So I think there are clearly benefits of that. There are other benefits which go to the governance part, where we have progressed also, and where we reap the fruits from earlier adaptations. Best parts of the Pillar 2 we have adopted some 5 to 6 years ago already. Having said so, looking at the other coin, Solvency II is clearly, in our view, the most advanced, the best supervisory system which is out there on this planet. However, at the same time, it is the most complex system which is out there on this planet. It is the most bureaucratic system which is out there, and unfortunately, it is also the most cost-intensive system which is there. We have started at the directive level with 300 pages of paper. we're going down to level 2, level 3, Commission, IOPA, our national law, interpretation by BaFin, interpretation by the auditors, and so on. Companies have to cope now with more than 7,000 pages of paper. So you have something like this. So this is about, we're going there towards a bureaucratic monster, and with the ongoing review, we might bring this even in a better manner up there. And this certainly amounts up to pressure on small and medium-sized companies. But I think it is not only small and medium-sized companies, this bureaucratic monster which is out there, which has its benefits, I've pointed out this, is becoming towards a burden to the entire industry. And Gabriel pointed at sandboxes. If other parts like fintechs are talking about sandboxes, that might be a hint that we have done a little bit too good and too much with regard to Solvency II.
Well, thank you, Axel. That's already setting the tone for the discussion we're going to have later. Michu, may I turn to you as a supervisor from a rather young insurance market, if I may say so. How did you cope with the introduction of Solvency II? How did you market, and how did you, as a supervisor, live through that introduction?
Thank you. Actually, Solvency II for us has been both a challenge and opportunity, and still is, of course. If I would apply, because we are among small and medium-sized undertakings, I could say also that we are among small and medium-sized countries and markets. And then if we are a young market, we are also a small market, at least in comparative terms, with Western countries. But we had a double challenge, if not more than that. Gabriel has summed up how do we work at the European level, and we wanted to achieve a supervision degree at the European level, which was not necessarily before. And actually we took 1 year earlier an exercise reviewing the market and increasing the supervision level, and we send the message to local companies with the Romanian or foreign owners, including Italian owners, that we are serious in supervision and that will be not a room for arbitration of supervision level. Actually, the exercise we took, and we reviewed the whole market to understand the level of capitalization and financial soundness of the undertakings. Then we had to make some corrections, and by the time when we roll out Solvency II, the market, I think, was clearly balanced, and people understood that we are not even a small market, and eventually a smaller authority, we are not less under supervision prospectus. The first things that we did with our companies in the local market was realize that increase the awareness and realize that we have the same understanding. And I think this is the main, actually, difference between market and companies, big or small. And we are talking about small companies, but with under the Solvency II, because we have some smaller that we are not Solvency II, but that we have the same understanding. People are moving between more relaxed, déjà vu or things like that, and people are more concerned. And then if we take that 90% of our undertakings under Solvency II actually have foreign owners that are part of European groups. We were more relaxed with these companies, which are more institutionalized, their supervision to implementation processes, and some of them internal models more complicated, and focus on the local ones if they have the same degree of understanding. And also, we have to apply, and in European terms, but also local terms, we look to the proportionality. proportionality meaning basically reduce the compliance cost and operational cost, but not reducing the risk, as we say. But we did not make any difference for the time being. If we're talking about reporting, we have same reporting requirements and for everybody. So that the first year was to everybody understand that these are the requirements, and I think that proportionality is mostly work in progress. Proportionality might be like subsidiarity in EU treaty. So actually that is certain flexibility, but takes time to implement it and execute, maintaining the level of the risk control, because actually what we are talking about is the risk control. If we realize that companies have the same understanding and they have their own mechanism simplified, and governance, for instance, structure, or reporting less often than the others, but that risk control is maintained, we could be eventually more flexible, but this is, as I said, work in place. Our main goal is to keep the same supervision level and requirements as everybody else. And Solvency II for us is an opportunity because transfer the European level of understanding and supervision. And second, work for simplification in line with what we do also at the European level, but make sure that the risk control is in place and you will not have surprises as we did or we had in the past of undercapitalization, sort of manipulation and other things that entrepreneurial level might be very innovative. So that stay quite systemic control and supervision. Thank you.
Okay, thank you, Mijo. So a good preparation, transparency, the same rules applying to all the market players. Luca, you're a representative from the mutual sector. How does this ring a bell to you? The same requirements, but I'm a mutual, I'm different. Or are you not different?
Yes, hello to everybody. Good morning, and thank you very much to President Rossi and to all EVAs for this opportunity. We are different in some things, and we will see in which ones. Let me say as a first thing that it's difficult after only 1 year to have a complete balance, and this also because this has been a year of working. It's normally like in Italy, we finish things at the last minute. So even in this topic, we are still working and try to imagine that some rules, very important ones, like the way we will treat deferred taxes, for example, is still ongoing in many countries and is very recent also in Italy. So we are still working on that, but I have to say I completely share what was said by Axel Welling in terms of the real things we can say. The first one is a positive one, and I think we have to say that the risk-based approach is definitely a positive evolution for the sector. I think we were pushed as industry to raise the awareness of risk and how we manage them, and this is a very good thing. And this is a very important thing for mutuals, because for us, you know, capital is a very important topic, because when it's finished, it's game over. So it's particularly important to have very attentive management of this topic. On the other hand, with the same frankness and transparency, I have to agree on the fact that finally we have a very complex baby, and that rules and requirements are a great burden and a great cost in some extents. And this is particularly true, as we said, for SMEs, and it's true and particularly true for Amice. Let me give you, in a glance, some flavor about the mutual and cooperative sector that I don't know if you know so well. 1 in 3 of European citizens are insured with mutual and cooperative insurers. 1 in 3. The market share of the mutual and cooperative sector in EU, it's more than 30% and has been growing in the latest years. So I have to say it's a model that is appreciated by insured and citizens. We are talking about more or less 400 billion gross written premiums and 2.8 trillion in terms of assets. And Of the more or less 6,000 insurers in Europe, half of them are mutual and cooperatives. So that means that many of the small SMEs in Europe are mutual and cooperatives, and many mutual and cooperative are SMEs in terms of the market. Why is that? Is this a fault of mutual companies that they are small? Well, first of all, many of them have a clear mission, a statutory mission. So they work on a specific segment for a specific affinity group. And so if you are a Mutuo dos Pescadores in Portugal, or if you are La Mutuelle des Architectes in France, this is your playing field. So it's delimited, and you can't grow more than this. But on the other way, and this is something you can see in how clients appreciate this kind of companies, in the other way, you are the maximum expert, and you have a great capacity to answer to the needs of this kind of clients. The second topic is that mutuals are different. And for example, in external growth, it's quite complicated. A merger between mutual companies, it's complicated. A cross-border merger between mutual companies is almost impossible. A cross-border group between mutual, it's extremely complicated or almost impossible. Here we have an excellent example in France that helped a lot, I think, the mutual system, that is the SGAM, the Société of Groupe d'Assurance Mutuelle. And this is a great opportunity in terms of legal framework to help mutual companies to maintain their specific mission, but at the same time to have a financial solidarity and to put together competences to do economies of scale, to be able maybe to face very high and difficult topics like cyber risks, like President Rossi was saying before. So we like the system. We think it fits also for mutual and cooperative companies, but I'm very happy to hear from President Bernardino and President Rossi that there is a great commitment in working on proportionality to reduce complexity, reduce cost, reduce the burden.
Well, thank you very much. We will be discussing that in a minute, but I'm going to turn to Jean. The Belgian National Bank just published its annual report and said, in terms of insurance, fit for purpose, everything is going well.
We said that?
Yes.
I mean, I don't
well,
remember.
that's what I read.
I think it was more nuanced than that. But anyway, if I had to answer the question you didn't ask me, but you asked the others, is basically to, as a general comment, as you said, Chairman, I mean, we are now in the early stage of Solvency II, so basically difficult to draw conclusions on this so far. We don't have a complete set of reporting available. The quality of data is relatively poor so far, which is basically an issue. But that said, I think we can draw some tentative preemptive conclusions so far. First, as many said here on the table, we have risk management capabilities on board with Solvency II. We have risk management process at the different levels and different layers of companies. Risk management capabilities created through the role of CRO, the management committee. We address the risky issues at the board level, which is basically new, and something which was badly needed. Second, the risk-based approach is also embedded in the pricing of products. We have that. Previously, at least in my country, many hidden free options were not priced, were even not looked at. No, we have to do that, and I think it's a good thing. And when we address that using a risk-based analysis of performance of these products and profitability of these products, then you notice that these products and some products haven't been profitable at all for many years, irrespective of the interest rate environment. Then we have also a trend towards market-based consistent valuation. In technical provision, we use the market rates and no longer the guarantee rates of the contract. We use also the impact of lapses in contract, in dynamic profit sharing in the contract. So basically, technical provisions are actually valued according to market valuation, which is, of course, needed. We have an appropriate trade-off between risk and return when it comes to addressing the asset side. We no longer have the asset looked at in terms of profitability, but also in terms of risk. So basically, all these items are positives. And I would even add an additional one, which is basically for the supervisor. Solvency II actually was definitely a step towards a more efficient way of addressing and addressing supervisory issues, and also more challenging for us, because many companies now actually challenge us in the way we supervise it, in the way we implement that, and I think raise questions, and it set the bar higher, also for internal models approval process. It's definitely challenging for supervisors to do the job. So basically, it was a huge, demanding step towards improvement on our part. That said, we also have to admit that Solvency II is a complex animal, and we have some issues as well to handle with. Insufficient data quality. We deal with that, and it's difficult because we notice that, and not only, but also for medium, small-sized corporations, they find it hard to come up with the right reporting and the quality we need. On the asset by asset template, for instance, definitely difficult to fill in, more than we expected. So basically, we need on this additional guidance from our part. It's definitely something on where we should do something. Second, of course, market valuation means volatility, and volatility means that sometimes you find it difficult to make your supervisory and to do your supervisory job, especially when you have companies nearing the 100% SCR, when you have to take preemptive measures, and you notice that from one quarter to another, they can actually jump to 140% or below 60, just in a small period of time because of the long-term evolution of the yield curve. And so this is something which is highly pro-cyclical, and that is embedded in the regulation, which is, I mean, problematic to some say. We also have, of course, the elephant in the room, the zero capital requirement for sovereign bonds, for sovereign risk. In my country, we have at least 55% of the asset sides basically invested in sovereigns. To claim that there's no risk associated to that, forget it. I mean, so basically we have one way or another to address that. We tend to do that through the ORSA, through the other analysis, but which is basically something on which, and Gabriel said that and I agree with that, we need kind of convergence in the supervisory practices. Of course in a proportional way, but in a convergent way as well, so as to avoid that every NCAs, every national competitor already do that its own way. Then we have some elements that are still complex to handle with. Some complex items which are difficult to define, hence to apply and to supervise. Loss absorbing capacity of technical provision, loss absorbing capacity of deferred taxes, contract boundaries, the unbundling into contract boundaries. These concepts are relatively difficult to handle with. And so basically we need there to enter dialogue with the industry, basically to explain what we expect, to explain what we want, and to do that in a smart way with examples, with a concrete base. So that's something which is definitely something to be improved. And of course, we suffer from a bad timing, because Solvency II was actually applied at a challenging time for insurance companies in low growth, low rate environments. So basically they find it hard to cope with additional regulation at a time where they find it hard on the business. So that's life, of course, and had nothing to do with Solvency II. Sometimes Solvency II is blamed for that, but basically it was definitely a timing which was not appropriate.
Well, that's very full explanation. Obviously, the low interest rate environment is a very challenging environment, but we see slowly interest rates going up again. Mr. President, maybe we'll get there at some stage. Christian, the French market is a big market. It was not always very excited about Solvency II. What is your first sort of experience in applying the new regime?
The first experience is rather good one. I think after, as you said, maybe during the process, not always the most enthusiastic about it, but we had a good start. Ratios are good. People got really in the process, also due to a different way of cooperating with the supervisor. And this is, I think, to speak about, not to repeat what some had, but I think the big difference between Solvency I and Solvency II is the relationship with the supervisors. And I think this has changed, but I think not fully embedded yet. And I think on both sides it's a difficult one. You know, on one side, not to underestimate, I tick a box on the Solvency I and my job is done, and today it's a challenge. It's an interaction between the supervisor and the companies. And there are some difficulties as well, you know, I'm interacting, but I'm a supervisor, but I'm not managing the company. So where is the line? And sometimes the line is not so easy to find. Just maybe also a small word, you know, we spoke about SMEs, but what does it mean in reality? I mean, if I take our market, if I take my association, we have 280 members, while I would say 260 are SMEs. So it's really a problem and an issue to take care of and to take very seriously, because in terms of numbers of market participants, this is the majority of most of the European markets. So, and there are actors, as Luca said, they are highly specialized, they are dynamic actors, and they are in niches where nobody is in. So in France, in our ecosystem between a listed company, unlisted, reinsurers, bank insurers, the mutual community is an important one, both in small segments, also in market leaders. We have in some important business lines, mutuals are the market leaders in France and are among the biggest companies in the country. So it is all an ecosystem which we need to take care of. Now, it was said, and in one way, I guess it hasn't helped the volatility. Volatility, you know, Karel, I remember you said once, if you get near the SCR, your supervisor will invite you to a cup of tea.
Or coffee.
Or coffee,
yes.
or maybe a decaf. But I think the thing is not so easy like this. We still are in the reflex of Solvency I, measuring, you know, 180, 100, 200% of SCR. So, you know, and this initially foreseen, as you know, we need to go away from this approach, hasn't really changed. And I understand. I mean, our colleague has said volatility, and we have observed volatility with a corridor of down by 30, up by 50. So it is extremely difficult in this new environment. And let me conclude with one thing on the first part. We look at solvency, but there are lots of other things where company, unfortunately, have huge burdens. Anti-money laundering reporting, tax FATCA reporting, others. So it's a general trend of compliance sometimes in a not very dynamic way, in a productive way. So you have produced documents in order to produce. And if there's one message, and after the beginning now of Solvency II, yes, we are in a complex world. A complex world helps nevertheless to say, let's focus on some essentials and saying, you know, what's really needed, and have the courage to stretch certain things which really are not helping the risk management, not helping the process, but simply add another layer of, you know, I have submitted a document, everyone is happy. There's a cost involved, and there's a lack of competitivity due to this, and some speakers have said, you know, we are in a world where Solvency II is probably one of the most advanced, but also one of the most complex system. Yeah. And if we can take some of this unnecessary complexity away, it will be the best system.
Thank you very much. That's a very good lead-in to the next theme of our panel. I think we can probably conclude the first round of questions by saying that people feel happy about the fact that the risk-based approach is an improvement, that there is a greater professionalism in the way the supervision takes place, companies do their business, but there is this issue of complexity. And as was said before, if we look at proportionality, which is a theme that I would like to address now, It's obvious that we've taken less interest in Pillar 1 issues on proportionality. And one of the criticisms that I've heard about Solvency II is that it's complex, people say, because it has been prepared by too many actuaries. Now that is strange. Actuaries are very bright people, and I've just wondered sometimes how you can define an actuary. And I came across this comparison. People ask me, what's the difference between an actuary and God? And in the end, the difference is that God knows he is not an actuary. And maybe that is the reason why in Pillar 1 we are too complex. And what can we do about it? And what I'm going to do now, and I'm going to start with Axel Wehling, is ask a very simple question to all the panelists. You have now a unique opportunity to give specific ideas on how to make proportionality more a live issue. And in answering that question, I want you to look both at the regulatory way of doing it, which areas do you believe we can tackle, we can give a hint of more proportionality, but also the supervisory, the two elements which are important, and particularly for the supervisors on the panel, I want to hear, how do you operate proportionality in practice? How can you improve that? Maybe the industry needs to do something before you can do something. So we want to hear it all very short, very clear. Axel, what are your proposals to make the system less complex by the use of proportionality?
Well, first of all, let me declare I'm a lawyer myself, no actuary. I think it is time to look back, to look at the figures, look at the results, what we have in front of us. And we will see that parts of the risk modules in some companies, mainly in the small companies, sometimes only in the P&C companies, have very little effect on the overall results. To give you a concrete example, I have small members where the default risk module account to up to 0.13% of the overall SCR. At the same time, the calculation of that module is for that company tremendously complex. They have demonstrated this now for 1 year that it changes from 0.13 sometimes to 0.12, sometimes it's up to 0.14. Does that really has an effect on the company, on the risk profile? In my view, not. So therefore, I think in a review, I would first say, if a company can demonstrate that a certain risk module, no matter what it is, has close to zero impact, then simply allow to write this on until nothing has changed. We have similar company or different companies where the lapse risk module, we see something similar. So I think it is time for that to look in the regulatory proportionality to allow sometimes simply to continue the status quo there and not to calculate this all the time. Second issue with regard to regulatory proportionality, I can understand that the call for advice from the Commission came that we need a review of the standard formula. I can understand that the actuaries in all our companies and in all our countries find something wrong. In some parts of that, I have the great fear that this review, this exercise, will add factor 2 of complexity in this exercise.
It should not.
It should not, but Karel, believe me, if we do not take this very seriously, it will. There is the clear danger, and I know Gabriel, we discussed this a number of times. There is this danger that our friends from the actuarial professions, but also industry itself, is coming with new proposals, which is making it even more complex at tackling certain problems. We have, from industry side, also wonderful proposals for a new infrastructure, asset module. How much do we have invested in infrastructure? In our case, less than 1%. Does that will change the overall risk profile? I doubt that a little bit. More complex, in my view, is the issue of supervisory proportionality. That is a change of culture with the companies, with the supervisors. We have so far experienced that in our companies, those where the companies say, yes, we would like to try something, which is encouraged by the top management of BaFin, then the supervisor which comes to that company barely would like to accept the risk of accepting these proportional solutions. And if they accept this, then the auditor comes and says, no, I don't want that. So we have to change somehow the mentality that proportionality is the norm and not the opposite. And to get this into the heads of companies and supervisors will probably take 10 to 15 years.
Well, I don't know whether you're an optimist or a pessimist, but definitely it was the intention.
Clearly an optimist.
An optimist, yes. It was clearly the intention that it should be like that. So, Jean, you as a supervisor, is proportionality something that when you get up in the morning and you go to the office, you say, I'm going to apply this today?
Oh, yes, we have to do that. But basically, I think there are some few concepts to clarify here. Sometimes it's presented that proportionality is synonymous with simplicity. And it's, I mean, often the case, but not always. We have certainly in some cases complex animals also within a relatively simple or relatively small undertaking, and basically the business is not simple for them. Because they covered risk models, wide range of risk models, so basically these are certainly not synonymous with that. On top of that, proportionality sometimes do not go along with simplicity. For instance, in the equity duration approach, we have a different approach set for different types of equity, participation, model 1, model 2, and I think it's very much risk-based and addressing the right risk embedded in the different equity categories. If we try to simplify and say, okay, we're going to sum up that to one single model, chances are that it will be quite simple, but a heavy burden for many companies because they say, okay, it's not attractive anymore to invest in this equity. So basically, these concepts are not to be confused with. But that said, there is, I think, clearly room for further proportionality in irrespective of the pillars. In Pillar 1, I think, of course, as Gabriel said, capital requirements are there for everyone, and there is no, I mean, need and options out on this. But I think some concepts should be clarified, as I said earlier, and this is the role of supervisor to give some guidance on this, to enter dialogue with the companies, basically to say, okay, we're going to make this simpler in the way we implement that concretely. We have that for like DT, for instance, for the lapse risk, for the competitive default risk, for the duration risk, where we try to apply this concept using the principle and basically remain faithful to the principle, but in a way that is relatively simple for the companies to understand that and to apply that, to make them applicable. And there is room for improvement on this, definitely. And I think the way we're gonna first use the review of the standard formula in the first place, and the way we're gonna focus, because that's a logical main focus on EIOPA, to have a more common supervisory approach is basically a good moment, a timely period to apply this. So I think there's still room for simplification and proportionality in Pillar 1, even though the rules are the same for everyone in terms of principal and capital charge. On Pillar 2, I think there's also ample room for simplification. Not for everything. Fit and proper, it's there for everyone. Sorry, the standards could not be made more flexible for smaller companies. But when it comes to address the way risk functions should be performed within the company, for instance, risk management, audit, compliance, actuarial functions, I think for smaller companies, for smaller business, it's logical to be more flexible on this. It's definitely so. And on Pillar 3, there is possible room for simplification as well. I think we should have some input from the industry to better understand what is really compulsory for them, where are the hurdles for them because we were taken by surprise on some templates, on some reporting, because we expect this to be relatively plain, and they find it hard to fill that in. So basically, we have to better understand it. We have to recognize that for some issues, they find it hard to find the appropriate data and to fill that in correctly. So basically, these are areas where we need some input in order to better identify the room for improvement and for simplification. That said, and in order to avoid that proportionality would be synonymous with less control or less supervision, we need some guidance from EIOPA as well. I think these moves have to happen in parallel with a move towards more supervision convergence on EIOPA side, because otherwise we will have a magnitude of ways in which national supervisors will apply proportionality, and that's not what we want. So basically, these moves have to happen together.
Very interesting. Sylvia, if you apply this to Ireland, Gabriel said unity in diversity. Is Ireland different from other countries? How do you look at proportionality in Ireland?
Okay, well, I'd say we're probably different in that we had the financial crisis, and that had quite a significant impact on Ireland. Following the financial crisis, we developed a model called the PRISM model, and basically the PRISM model, it looks at the probability and impact risk for a company. At the moment, we look at, okay, what is the impact? What is the probability? That can vary from it's low impact, it's standard impact, it's enhanced, or it's intense. So when you're looking at companies in terms of your supervisory engagement, what you're saying is you're determining a score for an entity, and you're saying, okay, it's low impact, but it's high probability. Therefore, the engagement with the company is going to be somewhere in the middle. If it's low and low, it's going to be quite infrequent. If it's intense on probability and intense on impact, then you're going to have significant engagement. So we've worked through a supervisory model that basically is based on the score. Following the implementation of Solvency II, what we said we needed to do was to implement more supervisory judgment in relation to that model. So now we're looking at what we call the smell test in terms of the company, and where the impact previously was, based on the size of the balance sheet, we're looking at it and saying, okay, we need to take some judgment here in relation to the entity. So that's really, I suppose, from the first side in relation to the supervisory model. If we look then at the whole, the governance side, what we would say is that we do take proportionality into account where, for example, for low impact companies in relation to the size of the board of directors. So, we require 5 as opposed to 7. Also in relation to the number of meetings for board meetings and committee meetings, we have a requirement for 4 as opposed to 6. So in that area there is some movement. Also, if we look at the reporting, we have implemented automatic exemptions for low impact companies. So I think in relation to, looking at proportionality, we do feel that proportionality is required. However, supervisory judgment, particularly where risk management frameworks are in place and aren't as developed as they need to be with small and medium-sized companies, that it is a firm requirement for a supervisor.
Very, very interesting. Miju, how do you look at that in Romania?
Thank you. First of all, I have to confess that I'm very humble in front of an actor. And I'm an admirer of the profession. And I think that brings the specifics of the insurance industry and what they did in Solvency II. I think they brought an additional professional level into looking to the business. I'm talking about a young market and a small market and the perspective of our markets, which are mostly plain vanilla products. We don't have mutuals, we don't have cooperatives, we don't have even as much health and life that we look to the investment. But when you look to the plain vanilla products that I saw and what we want to check, I said that we have the same level of understanding, is sort of a mindset. How do you look? I've seen examples in Romania where people were focused on sales, and eventually adjusting the prices. They sell again, adjusting the prices. Ended up, after 10 years, they build up sort of Ponzi scheme. Then they collapsed. So actuals, they come to teach you that you have to look to both quantity and quality, and to that which is the attitude toward risk. You are not big or small, you have to be sound. And when you are that actually comfortable, and then it was said here earlier that when we look to the new supervision is actually dialogue and communication. And when you talk to the people and you see that management, which have to generate the Warsaw, and they have the different understanding, or at least the understanding and the risk awareness, and that is not as much important how much you sell, that it's important how much risk you buy in, then you are relaxed. So actually you change and you send less inspections where the people conduct, they want to see where the authority, they want to send inspectors, and this is more off-site. But I think it's paramount important that you have the same understanding. And we haven't seen that entirely. As I said, I mean, lucky enough or that more European groups are in the market, but when we look also to our countrymen or to other entrepreneurs, if they change anything in the approach, not necessarily internalizing a corporate system and looking to these functions, but then if themselves they understand that the plain vanilla means that you put aside part of the money for in the sunny days for the rainy days, but they think that those comes might not come, or they will postpone then. And what we see now, there are companies which are completely out of, let's say, at least legal requirements for consumer and paying, settling the claims, for instance. And this is the beginning. And we look to both ends of the process. How much money you have to pay and how much consumers staying in line to get the settlement for their damages and for the claims and for the files. So actually, I think that actuary will come in and will more prevent this situation not happened. And then you make the right technical reserve provisions calculation, and you put the money aside, and then you go ahead. Again, I think this is irrespective that you are big or small. So, understanding and training staff. I think we ourselves, we train our people, we bring our people, because that is a higher level of understanding and additional requirements. They should do the same. When I said that this is a moving target, proportionality, and the work in progress, more milestones will be set, then we'll be more relaxed, and we reduce eventually the level of reporting and things like that. We shall see now in May, because this is the first time, full reporting, all insurers, and see where do you come from here. That is my understanding.
Thank you, Miju. Luca, can you give us some ideas about proportionality, some specific examples where we can sort of make things less complex?
Well, Karel, I will start from a topic that, from my point of view, is very important. It's that one of the most complicated things is to do simple things. And we are facing this as an industry because digitalization, that was in the speech of the two presidents at the beginning of the day, digitalization is bringing all the industry to face how can we simplify things for the clients. Because we are now facing not only the new generations, but everybody that is getting used in some other sectors to buy with 2 clicks and to do simple things. So those clients are also our clients, and this will be even more difficult in the next years because the new generations are arriving. And so we are working hard, I think, in many companies to sit there with all the functions and to look on a constructive and critical way to the way we work, to the way our processes are structured. Are they simple? Are they adding value for our clients? So more than entering on a specific topic, here are persons that are much more competent than me to do so. I strongly buy, if I well understood the method that was proposed, that is, let's look and walk back all what we did in Solvency II and try to look if we can simplify that, if we can give it on a simpler way with the proportionality principle, but maintaining the guidelines, the substance, the essential elements that we all bought now about Solvency II. So starting from Pillar 3 and going down to Pillar 1, where of course it's more touchy and more difficult to simplify, I think we have many things. In Pillar 3, we already talked about that. Is it sure that we need all this amount of report? Is this sure that being so quick in terms of release submission timelines, it's a so important thing even for small companies? Because, you know, passing from 7 or 8 weeks to 5 weeks, it's a big reshaping of the processes for many companies. So can we rewalk from Pillar 3 to Pillar 1 with this kind of method, with this kind of approach? Amice is for sure ready to do so if it can help, and we are collaborating very well with EIOPA, and we are at total disposal to work on that.
Good. Christian, what do you think? What proposals can you make?
So, I mean, a lot was already said, but for example, where an underwriting risk in non-life is insignificant, why really to calculate? But on what was said, I think we are nevertheless facing a dilemma, and coming back on what Gabriel said, we are in a process where we basically have all the different understanding what proportionality is, and maybe a different approach, but at one point it needs to converge. And we must be very careful that regulation is not constantly open, because we are insurers and what we like is stability. We like stability. And this is a very, very important, and I don't have the answer on it, but we, for example, in France, there's a tendency to take soft law and to translate it into hard law. And we do not want that our Code de l'Assurance is open constantly and changes constantly. So this is one of the dilemmas, but simplification can done easily without having a major impact to the system. For example, on the reliance, and we haven't spoken about it, on third parties, so rating agencies, certification, you know, but also this is confidence, and Jean mentioned, you know, data quality, but if the supervisor and the company agreed that the quality of data is okay, do you need to certify it externally? Do you need to have external cost-intensive input in the system? These are questions that are important. And coming to Luca's point, yes, we have more and more actors that slice part of our value chain, that pick one important thing of the value chain. They simplify it the maximum way is, and this is what client wants. Maximum 2 clicks and you buy it. You buy insurance today for an hour, for 3 weeks, you know, and this is what both is an opportunity, but also a danger to the mutualization, to the concept which we base mostly our business on. And so we need to be really courageous in one time, and we need in one way to be quick, because it cannot be a process where habits take place at the national level and then 3 weeks after or a couple of years after saying, you know, because Gabriel does his work on convergence, so let's change everything again. So it's a dilemma which only works if we work very closely and quickly together.
Thank you. Well, you see, ladies and gentlemen, when we talk about proportionality and we ask for specific examples in terms of where can we change the regulatory regime, you see that is very difficult to find examples. And I do remember when we were negotiating Solvency II, and I wrote the principle of proportionality in the text. Gabriel will remember that, because I thought we need that. And we made it quite clear that it was both in terms of the regulation and in terms of supervision. What we learned from this panel now is, I wrote down the word impact. Maybe what we should try to do is to look more at the impact of some of the rules, and maybe have somewhere in the system a message also to supervisors. If the impact of something is minor or marginal, supervisors should take that into account. Maybe you already do that in Ireland, maybe you already do that in Belgium, maybe you already do that in Romania, but maybe a message that is more strong to supervisors to do that could be helpful for the industry. Now we are approaching the end of the session here, and I don't want not to give the floor to you, because you have come to listen to us. Maybe you are totally shocked. You say, you didn't ask the question, the elephant in the room, you haven't seen the elephant. Does somebody see an elephant that we haven't touched? Does somebody feel strongly about a message he or she wants to pass on to the members of the panel? Maybe a challenging question? You have the floor. There is a microphone over there. So if you take the floor, please say who you are so that we know who you are. But feel free. It's a unique opportunity to say what you think and to think what you say. If that is not, I mean, I'm not challenging you. If you don't want to be challenged, I'm going to challenge my panel members for one last question. And I'm going to ask them a very simple question. Looking forward, because that was the last question I was going to ask, and you know that, can you name me the 2 main challenges that you see for the industry in the years to come? Just 2. And I will start maybe now. I started with Axel, now I'm going to start with Christian. Christian, the 2 main challenges for the industry going forward.
Let me be. Let me say one more political one, and to say to Gabriel, I think it's the future of the European Union. I think for us, for an industry which is used to work, and Solvency II is probably the biggest project that the insurance industry in Europe has ever done together. And for me, this is the challenge, to not to slice Europe in different areas where different rules apply, and we see already a beginning. So this is, I would say, an overall challenge. And then the overall is the economic environment, and to move in this complex economic environment, and to safeguard the diversity of our markets and the service we offer to our clients with the security we have. And it was mentioned earlier by President Rossi, you know, we offer protection, and in the life insurance, we are amongst the few players who can offer lifelong provisions to the end of the life to protect consumers.
Great. Luca, 2 challenges.
Well, the first, just also to change a little bit, I'll choose the one of maintain biodiversity. I think Europe is rich of diversity, and I think our sector is rich of diversity. You've seen that in terms of mutual, non-mutual companies. I would like that one of the challenge could be the fact that having a common system doesn't mean that we are all the same and we maintain biodiversity. On the other hand, I think digitalization is one of the other main challenges for the sector. And it's a challenge that is complicated by the fact that we have many structural challenges at the same time. Solvency II, the EDD and POG elements that are arriving. So the difficulty today is not only to face a huge challenge, but to face many huge and structural challenges. Digital is for sure one of the big ones.
Mijo, what would you think?
I think that I'm more lucky because actually we are in an emerging market and fast-growing market.
Lucky you.
Insurance last year increased with double-digit, and then I would say the MTPL market has increased 30%. Actually, what the challenges in my country will be to have more undertakings, more insurers, local or foreign. That market is quite concentrated, and we see in that. So there are new players coming into the market. And second is diversification, product diversification in the market, which will lead to a better stability and market going toward more maturity. And if we reach the same level of supervision, regulation, single book, and European, then should allow us to grow more. So actually, my invitation is to get more players in the market and more products. These are two main challenges for us. Thank you.
Did you hear that invitation, ladies and gentlemen? Sylvia, what do you think?
I think looking at it, for me, the two challenges are consumer protection and digitalization, which actually both merge into one. From a consumer protection perspective, consumers are concerned about the products that are being sold. They're concerned about ensuring that they are protected when they buy those products. As an industry, as an insurance industry, we need to ensure that the products are fit for purpose. We need to ensure that those products are the right products for the right people. As a regulator, we need to ensure that we are effectively regulating the products that are being sold. That, for me, is a huge challenge. When we look at digitalization, we've got products coming down the line, and we've got a mindset that is going to need to be there that we haven't thought about. When we look at, for example, driverless cars, we're looking at a significant disruptor in our industry, and how are we going to deal with it? Do we have the resources to deal with it? Do we have the competencies to understand what are the opportunities and what are the challenges? If we look at the focus of the industry, or the conference here today, we're looking at small and medium-sized insurers. When we look, as I went to go back to my initial analogy of the child, teenager, adult, for digitalization, who is best placed? Is it an adult or a child? It's a child. They respond quickly, effectively to digitalization. As a parent looking, we need to protect the child and we need to protect the small businesses, but there are huge opportunities going forward for small and medium-sized insurers. As a regulator, we need to be more and more focused on what it is that the small and medium-sized insurers are doing and what are the risks they're facing. Excellent.
Jean?
My two challenges are not directly Solvency II related. It's first the low growth, low rate environment, and second digitalization. On the first one, I think it's of course a question of low rate in a protracted low environment, but basically it's more than that. It's more than monetary policy. It's basically that the equilibrium rate between saving and investment is definitely too low. Yeah. And when it comes to an environment in Europe where investment is too low, it's a problem for investors. So it's a problem for insurance company. And that's definitely a big challenge. On the second one, digitalization, it's really disruptive in a way it will affect the business. in which products are designed, products are distributed, data are protected, consumer protection issues related to that. And for some existing companies, as Sylvia just said, you have digital natives and digital migrants. And existing companies are not exactly digital natives. So basically they have to cope with that, you have to deal with that. And a key issue will be actually the heavy burden of IT investment compared to legacy IT system. And so many companies are not best placed to face this business, especially when facing competition from other actors which are concentrating on the most profitable part of the business, the fintech companies. So basically it's a huge challenge as well.
Thank you. Axel.
If I'm short, do you allow 3?
Well, give it a try.
I think after Trump and Brexit, the political risk with the upcoming elections this year in a number of European member countries is clearly the number one risk would be on my agenda. Second would be low interest rate, while I'm probably more concerned about a sharp rising interest rate at the end of a long low interest rate period. I believe we would be able to cope overall with a certain low interest rate, but with a certain jump up that would be probably more difficult. Third is also on my agenda, digitalization, with a little bit different flavor. I would put it, how do we understand the needs of our clients in the future? We have a great mentality in our companies between sales forces and actuaries to know amongst us what is best for our clients. I think through digitalization that will change, and we probably will have to find new ways to understand what are the real needs of our clients, and not that it is us who declare what are the needs of our clients.
Thank you very much. Well, ladies and gentlemen, that pretty much concludes our time for this panel. What can we keep in mind from the last tour de table? It's that there are still a lot of opportunities all for small and medium-sized insurers. What we need to do is to find out what are the needs of the consumers. Digitalization is a disruptive element, but offers opportunities, and particularly for niche players, as was pointed out by the President this morning, there are opportunities. The only major risk is, and then we fall back on Solvency II, that if you don't take account of the risk of not looking into these developments, your business may be at risk. And that's what your ORSA should tell you when you look at yourself and to see, am I the child, or am I already a senior or a retired operator in the market? And then to conclude, ladies and gentlemen, I started out by saying we are in Rome. Rome was not built in a day. It was the place where the European Union was founded. And we heard on this table that people are saying, we want Europe. We believe that that is the way forward. Let's remember that, ladies and gentlemen. Thank you very much, and join me in thanking the members of the panel.